All right, what's up, everybody? We're back with Craig, SCHD Stan. What's up, man? Thanks for coming back. It's been 2 years. Can you believe it?
2 years, man. Time flies when you're having fun.
I forgot it was 2 years, but I got a comment from RJLT4841 who did remind us 2 years later, how about an update? So we're going to do an update video. And if you haven't seen it, just watch the other video so we can get right to the good stuff. And the good stuff, dude, is that your position in SCHD, you were the $96,000 SCHD investor before, but what are you at now? You've had a substantial increase. So what's it at and how did you get there?
Yeah, so it's over, well over 200,000 in value right now. So 7,755 shares or something like that. Because I bought five more today. So yeah, I think I'm up to that now. So yeah, it's funny because the last video I was like I've doubled since the video before that, and now I've more than doubled since then again. So
How are you getting to that? Is that all fresh new capital or what?
oh
How'd you
no,
achieve this?
no, like a lot of it, it's both. It's new money coming in, and it's selling stocks and moving them into SHD, consolidating other ETFs, stuff that I've done well on, using it as to preserve the wealth. So like if I've gained a lot in a stock, I can sell it, move it to SHD where it might be a little safer in the long run, and I can make some income off it. And then there's also mistakes that were made and stocks that didn't do well, and I took the tax loss and moved that to SCHD. So there's a lot of that too.
So we're going to get to some listener questions I asked on Blossom and you asked on a good old X. But a question of my own, do you care to share or tell us what a little bit of the method to the madness is with what you may have sold to consolidate into SCHD? Any interesting positions or what's your position size? Do you off the top of your head, by the way, know how many in your investment portfolio universe, how many positions you have
Oh,
currently?
how many? Oh, I still have too many. And I think I've come to I'm okay with it now. Like I'm able to manage a lot. I don't even want to say how many because I will get destroyed. But I have a lot. But I've cut it down from even more. It's really okay because I'm not Warren Buffett. People that are really good at this can say, you're diluting yourself, you're hurting yourself. Well, I'm not that good at this, so I want to have a lot of different moving parts. And you know what? A good chunk of it, what the big part of it is, I have a big dividend portfolio, and I find with dividends stocks, they really manage themselves a lot more. And when you see like the dividends start being in trouble, like that's a pretty good warning sign that things aren't going well. So as long as they're increasing the dividend and that's moving along, it's a pretty good sign things are healthy. That's your quick way of keeping track of it. So you'll often get a little alarm when it's time to get rid of the stock because you can see that that's not going up anymore. Long story short, yeah, there's a lot of holdings. A lot of them are a big chunk of my dividend portfolio. And then I have also, because I used to live in Canada, I have stuff in Canada, I have stuff here. I have a growth portfolio, I have a dividend portfolio, I have an ETF portfolio. So I try a lot of different things.
So, what did you sell? A couple positions, or what's something you consolidated into or out of? I guess.
I mean, even going back to like, 21 when I had a lot of SPACs and stuff like that, some of those were just leftover stuff that I still had. And some of them turned out to, go up. And then once they did end up going up, I'm like, okay, I got to get out of this before, I don't know, stuff like Open Door or things like, my gosh, I can't, honestly, I can't even remember a lot of them, but those names. There's a lot of them that were going wild in 2021. And they're actually, a lot of them are back now, funny enough like Open Door. I bought a call and made some money off Open Door just recently again. So it's pretty crazy. It's starting to feel like 2021. So that might tell you something that's going on. I had a lot of other like lots like VYM. I had a lot of VYM and I consolidated that recently into SCHD when it's been doing really well. And I took those wins and moved it into SCHD. So right or wrong, I got those wins and we'll see how it goes from here.
Gotcha, dude. I didn't know you were a SPAC man. How about it?
Weren't we all in 2021?
No, I never was a SPAC. Stayed away from. Dude, I avoided SPACs like I'm avoiding the covered call ETFs. He's back. It's the return of Chamath Palihapitiya. He's back with more SPACs. Like he's.
Yeah, see
That's
what I
when you
mean?
know.
It's 21 all over again. He's back. It's happening. And what happened in 22? So just remember that it's possible again.
I think SoFi was his best performing SPAC, but most of his SPACs didn't work out very well.
So
So
far, I had that too. Yep, that's one of them.
we could just segue right into that then, since I, broke into the next question. But yeah, so I think a lot of people have soured on SCHD, and I don't know if you feel like I do. I think many people, when it was the hot thing, I know I'm a YouTuber. Everybody, if you did a video on SCHD, I remember there was people, one thing to buy, SCHD, that's all you need, getting crazy views, and then it shifted, and all of a sudden people are out on SCHD. It's not the hot, it's the old flame. What do you think about all that? Do you think that people didn't understand what they were buying, or what do you have to say to all the people that are soured on SCHD and saying like, forget SCHD?
People like, whether they know it or not, they like the trendy, they like the hot thing, they like the momentum, right? Whatever's good right now with the stock market, if it's going up, it's great and it's never coming down. If it's flat or going down, it's going to continue that way. And that's just the way, especially with people that haven't been investing that long. That's the way they started. What's working now, they feel like it's always going to work. And, and it hasn't, the returns have not been fantastic for SCHD lately. So it's only natural that somebody's going to look at their portfolio. They're going to see everything else is up 20% and they see something up, so SCHD just chugging along at 4 or 5, 3%, whatever it's at. And it's going to be disappointing. And people will just look at that and say, well, let me sell this and keep this, and then you got all the high income covered call ETFs that make SCHD's yield look minuscule in comparison, right? So on one side you got the growth that have done amazing, and then when you look at dividends on the other side, now you got these high distributions. It's not dividends, it's distributions in these covered call ETFs. SCHD's kind of stuck in the middle. And it used to make everyone happy because it was like the best of both worlds. Now people see it as the worst of both worlds. So it's kind of, it's stuck in a tough spot right now.
To quote Will Smith, the covered call ETFs are the new hotness. SCHD is the old and busted. But speaking of that, on the screen, I ran this, dividendchannel.com. Anybody watching, go there, use their drip returns calculator. It's pretty cool. You just pick two ticker symbols and you can compare their performance. I thought it was interesting that SCHD, with dividends reinvested since we did the video, it came out August 4th, 2023, has had about a 9% average annual return. But VOO, which is the Vanguard S&P 500, top 500 stocks roughly in the United States, 21% return. So it's crazy because historically, a 9% average annual return is pretty good, but we're in this crazy time. So Craig, Mr. SCHD Stan, what say you about all this?
Yeah, I mean, and that's it exactly. Like people now have gotten used to the market, the S&P 500 returning 20% per year. And that is just not normal. This has just been an incredible time. And SCHD is just kind of chugging along at something at a normal rate. And right now, normal looks terrible. And I just believe that over the long run, it will even out. Like I just don't think we can expect to get 20% per year going forward. And that's the history of the market has been closer to a 9 or 10%. So I've always said that in the long run, SCHD is going to get you an S&P like return. Probably a little less, but it's going to be right there with it. And it's going to keep growing and paying that dividend. It's going to be more stable because what happens is when there are tough times, it's a lot more resilient. So people look at the lead that the S&P has and they say, how could that ever change? Well, it changes very quickly because as stock market takes the stairs up, but takes the elevator down. When there is a correction, it will likely drop a lot more than SCHD will. And that tends to make up the difference. And at the end of the day, I really don't know. But just over long, long periods of time, we're talking, 10, 20, 30 years, these things tend to even out. SCHD is more of a value play, and it's more so than ever. Like it's the difference between the value that SCHD is and the growth and tech that the S&P has not been this different in a long time. So that will help you in tough times, even though it hasn't recently. It didn't during the tariff thing, but we can get into that. That's very different to me than an actual real like economic correction. That's more like news related and just uncertainty related. That's everything drops in that sort of scenario. And I know a lot of people were like, "Well, it didn't hold up. What happened?" But that's to me, that's a completely different situation, and it's taken SCHD a long time to rebound because it just doesn't have the growth, the tech, the hype that the stocks that are now dominating the AI. Really, it's all about AI that's dominating the S&P now.
Yeah, I guess you didn't get the memo because we're not doing recessions anymore. So I've already made my peace with it. Maybe that's the what we need because when they say when everyone throws in the towel, this thing's never going to go down ever again is usually when it probably will, or when people capitulate and say it's down so far, it's never going to go back up. That's when it goes back up. You know, it's funny. I was floored when I saw this because in the video we did 2 years ago, your bold claim that we used to sell and package the video with a pretty little bow on it was that you could have a Warren Buffett with Coca-Cola like type return over 20 or 30 years. And all it had to do was be in like that 8 to 10% average annual total return. And what do we see after 2 years? Even without dividends reinvested, we're over 8.5%. So it's at the lower range of what you were expecting and predicting. So I was like, dude, he was spot on with that.
And also what I was talking about as well was the like what Warren Buffett did with the dividends of Coke, right? Where in 30, 35 years, every 2 years, the dividend was paying for his initial investment. And that was a big part of what my big claim was, is that in 35 years, SCHD could be doing that with the dividend as well. And that's still on track as well. So the dividend growth has been, it's up and down, but it's still long term. It's still 11%. I think the 5 year is like 8 or 9. And this year will probably be a bit lower, but we have to remember that in 23, we only got like a 3.7, but then the following year was 12%. So this year we'll probably see, this is breaking news, like 5-6%, right? Like I track this pretty closely and add up all the dividends. And I think this year people are going to be disappointed. It's going to be a 5% dividend growth, 5 to 6% this year. That doesn't mean that the next year we're not going to get a 12, a 10 or 12. Like it's not a straight and up and to the right. It's going to be choppy. But in the long run, we'll get an 8 to 10 is realistic.
I guess I would add on that, and I think it'll be in one of our questions later, but SCHD shouldn't be your whole entire portfolio or holding. Like, no, I know some YouTubers said that, and that's why I knew we had jumped the shark when I started seeing bigger channels saying, like, you only need one thing, it's SCHD. I'm like, all right, come on now.
Yeah,
Like,
yeah. I got a lot of messages. I get a lot of messages, not anymore, but I used to get messages. Should I just put it all? I opened a Roth. Should I put it all in SEC? The number of people that were surprised when I said, no, what are you doing? No, don't do that. They're like, really? I see the SEC stand.
we probably should have started the video off and reminding people this is not financial advice. This is a passion of ours. This is something we love doing, love learning about, and sharing with everybody. So, yeah, none of this is financial advice, and we could be absolutely wrong. Speaking of SCHD now being out, being the old and busted, and talking about the new hotness, do you mess around? Do you F around with any of the covered call ETFs at all? Is there anything that interests them about you? No, about them.
Now,
Interest you about them. Did I just ask you if there's anything that interests you about you? I'm leaving that in because that's pretty
I
cool.
don't know.
I'm proud of myself
I've had a
for
long
that.
day
So
too, so I don't know what you're saying. I have no interest in yield max stuff. I'm open, that sort of thing, like those 50% and up, whatever, 30% yield and up. And I'm open to learning about it. I've tried, I'm looking into it and I'm trying to read, I'm asking questions. And it's still, everything I look at, it just seems way too good to be true. Yes, you can get your money back within a year and a half, possibly, but then the returns that whole time will be dwindling and dwindling and dwindling, and your actual initial capital could be completely almost gone. And sure, you're getting house money, but it's getting smaller and smaller all the time when you could have just invested in the underlying, which you made a bet on in the first place because your covered call has to do well, your stock has to do well. So you made the bet on the stock. So just invest in the stock. Like you're adding risk. You're taking the same downside risk. So you might as well jump in on the real stock and enjoy higher gains because the covered call version is always going to underperform the underlying. But now if we talk about stuff like, oh, did you want to say something? I'm sorry.
oh, I was just going to correct you if that's okay. I don't hope you don't mind. Just it's a small little nitpick distinction is that with these covered call ETFs, like, because I've looked at all of them and they call it actually a reference asset because it'll say, for instance, TSLY, which is Tesla's yield max fund. It'll say you don't own shares of Tesla. We don't invest in Tesla. It's derivatives, it's options contracts. They've got things like government bonds in there and treasuries mixed in. And it's a complex web that I gave up. I tried to understand it. And apparently people have informed me I'm a knuckle dragging moron for not investing in these and going YOLO all in on them. That's why they almost always underperform the reference assets, because you're paying a 1% fee. They're derivative contracts, they're options contracts. And from messing around with options that you get immediate income, but you limit your upside. So if and when these stocks do start to rip higher, you hit a ceiling and then they have to sell more contracts and they're missing out on exactly all of those. So almost every single one I've looked at since inception has underperformed its reference asset. And people say, yeah, not buying it for that. Okay, whatever. I'm just too stupid to understand it. And I guess I'm going to
And
miss
now
out.
I hear
So
the strategy is you buy them when early on when they're new, or you buy the big dips and then you hold on to that for a while until it starts falling apart. Then you sell that one and move to another one. And it gets very complex. Hey, if you want to do that and it works for you, go for it. But
yeah, go ahead. Put it in the comments below. I don't care. Tell me how I'm wrong and I'm missing out.
I love to learn about it. I love to discuss it. But I do think in the long run, it's not going to end well for a lot of those. So good luck to you. If it does, that's great.
And the fund managers, they'll make that fee, that management fee, no matter what. Up, down, sideways, they're going to get paid. So just remember that.
I don't mind the ones that follow like the indexes, like like the ones that what did you call it? Like not synthetically follow
Reference asset.
the
Yeah,
reference asset of
reference
the.
asset. Well, it's a good point with SCHD. Like the underlying is the underlying of the fund.
Like the ones that I do think are worthwhile, like doing very well, are like the ones that follow the Nasdaq or the spot.
JEPQ or
Yeah,
JEPI, I think, are two of the
PQIs.
OGs that those are two of the OGs. But from what I understand, people scoff at them because they have yields of, I don't know, 12, 13% or something. And that's just, God, why even mess around with something that low? What are you going to do with a 13% starting yield?
I really like the idea. A quick thought. I like the idea. I had Spy Eye, right, which sells covered calls on the S&P 500. And I looked at that and I said, like it's always going to underperform the S&P for the most part, right? So really, why I don't need this income now? Why am I doing this? And then on X and discussions with some folks, I came to the conclusion, with the help of someone else, that if you do one of the Nasdaq ones, you have a chance to outperform the S&P 500. So then I thought about that and I said, that's kind of interesting. When you're not comparing it to the Nasdaq versus the covered call version, if you look at the covered call version compared to the S&P, it actually has a chance to outperform. So that's actually really worthwhile, and it's a great way I feel to like ride the bull market, get a little income, and possibly good chance of outperforming as long as we're in a good market.
Yeah, I mean, if you have a chance to outperform, that's great. But with most of these, I don't see any of them outperforming. And the ones that did, it's barely, none are outperforming. Like I think MST MicroStrategy and MSTY with dividends reinvested when I run that are distributions, but they call them dividends for the sake of that. It's like 100% that MicroStrategy, which doesn't pay a dividend. That should tell you something that is 100% total return further ahead than the thing that's paying like a 90% yield. It's just, anyway.
That one's starting to fall apart too.
Yeah. The main question you should ask is, if you're in wealth accumulation mode, you're trying to build your wealth and grow your wealth. I don't understand investing in these. And I think it's much better to just go for the reference asset, call it the underlying, if you will, or just the S&P 500.
We're investors and we're looking at holding these things for decades. Then just hold the underlying and get those 10% per year compounding, and right now even more, as we saw just in the index, right?
Well, speaking then of underlying, I'm so happy you brought that up to segue us into it's the top 10 holdings when we recorded of SCHD. So this is from August 1st, 2023. And dude, there was Broadcom.
Trigger warning, trigger warning.
Here we go. Here we
go.
go.
Very upset about Broadcom not being in there anymore.
And this is what you say. You trust the process. But yes, would it be nice if it was in there? It would probably be a mass. I don't even know how that would work because it's just gone haywire. So it would be a dominating the fund. But the way the fund is structured, right, it can't go past a certain percentage.
Yeah, and not even just that. I mean, it pays an under 1% dividend now. So you can't have, SCHD is a high yield dividend ETF. It can't carry something with a low dividend. It doesn't follow the rules. It has to stick to its rules.
So anyway, it was Broadcom, Home Depot, AbbVie, UPS, Texas Instruments, Cisco, PepsiCo, Amgen, Coca-Cola, and Chevron. So that made up 40%. And then here we are. This is the current, right down there, September 9th, 2025, when we're recording this. Top 10 holdings, a lot of the same names. Home Depot, Chevron, AbbVie, Altria's in there now. PepsiCo, Merck's in there. ConocoPhillips is in. Cisco, Verizon, and Amgen. So still about 41%, 103 holdings, but this is the underlying that you're investing in. And there's 103 holdings, but this is right. This is the rules. This is what you're buying under the hood.
Yeah, and there's not a lot of change, right? Like other than Broadcom being gone, it's very similar.
So yeah, you always have to look at the underlying. With any ETF, it just is going to be more to your benefit to just do a little bit of homework, lift up the hood, see what makes that ETF run and how much it costs to make it run, right?
Mm-hmm. Absolutely.
So there we go. We'll go right into, I should add some intro music here for questions. We asked people on X and Blossom. So we'll kick it off with Tim Matthews on X said, would Broadcom ever be back in the mix? Is there any possibility of aerospace and defense in the mix? And what share price would SCHD split again? First off, do you think Broadcom would ever be back in the mix?
Yeah, Broadcom would have to increase its dividend significantly or drop in price significantly so that the yield goes back up. So it's got to a level, it's gone up so high now that back in the day, it used to pay like a 2.5, 3. Actually, I think at some point it was a high 3% yielding. It's flown up so much now that it's an under 1% yield. So based on the rules of SCHD, it needs to have a higher dividend. Basically, it's like higher than average dividend. It's not going to make it anymore. And what that does, the reason that rule is in there is it's one of the reasons why SCHD has such a reliable dividend growth, because it's not only reliant on the organic growth of the holdings, it's actually boosted by the fact that new stocks are put in and lower dividend stocks are taken out. So high yielders are put in, lower yielders are taken out. So that gives a little boost every year to the dividend. So it increases the chances every year that the dividend is going to grow. And it's worked so far very well.
I love that explanation. Dude, you're like the master mechanic for SCHD. I love it. You're telling us not only what's under the hood, but the exact specific components of the engine and how it's running. So I'll ask you then his second part of any possibility of aerospace and defense being in there. And right, you got Lockheed Martin.
Yeah, I mean that's a good proof that there can be. Lockheed Martin is in there. And again, if they meet the rules, it's not about the thing I like. One of the things I really like about SCHD is there's cold, hard rules. Like it's not something like, hey, we like this industry. Let's get more of these type of stocks in there because it's hot right now. It's just not the way it works. If it passes the screens, it passes the screen. So if one of those stocks has enough higher ROE, if it has a good debt to cash free cash flow ratio, consecutive years of dividend growth, a high enough yield, and a good 5-year dividend growth average, it will qualify. A few other things in there as well, but those are the main things. So if one of those stocks in an industry that you like makes it, it makes it. It's in. That's it. That's all it takes.
And then that's why there's no REITs, right? Because the dividends aren't qualified.
Yeah, that's part of it. And it's true. They want only qualified dividends, but they know that REITs don't pay them. So it's actually in the rules that there's no REITs allowed.
And then what are the what share price do you think SCHD would split again?
Wow, that's who knows. I never thought the last one would come. That was a shock to me when it was announced, because people used to ask me all the time. I said, I mean, it's not an expensive stock. It was, $70, $80 at the time. So why? I didn't think a split was necessary then, I didn't necessarily. Who knows? But I just didn't think they were going to do it, and they did. So who knows? I would think if it got back into the hundreds or something again. But
yeah, I thought it was fine too. But if you remember, it was Schwab, it was SCHD, SCHG. I think there was one or two more, and they all split on the same day. So it wasn't just SCHD that split. So it was Schwab. So I guess that'd be a great question. Call up Schwab's customer service and see what they say.
They'll give you a more vague answer than I gave.
Exactly. That's what they're paid to do. They're fake professionals. All right, Big Double E44.
Big E.
He says, have you made any changes to your SCHD strategy over the past 2 years?
Not really. I probably refined it more. Like when I first started buying shares, I would do things like I just find like little tricks to buy more shares. Like I wanted to encourage, like even if the price was going up, to try to still buy, but not buy too high. I wanted to kind of always buy dips. So I did things like, let me look at the 5 day low, and if it hit the 5 day low, I'd have an order set up at the 5 day low, and it would trigger a sale, and then I'd start looking, and if it kept going down, I'd buy more, and it went down, I'd buy more, and stuff, things like that. It hit the month low, I'd buy even more. I had levels, like if it hit this price, I'd buy 5 shares. If it hit this 10 and 20 and furthermore, now I look at it more as a percentage off the 52-week high. So I'll start buying at 5% off, and then 8% off, and each level I would look to buy more if I have the funds, right? 10% off, and then 15% off is when I like really start going heavy. And that's really helped me keep a low cost average. My cost average with all the ups and downs is still around $25, and it's trading around 27.50, 27 to 28 right now, depending on when you watch this video. Hopefully higher, maybe lower is good too. I'm happy either way. If it goes up, my shares are worth more. If it goes down, I can buy more for cheaper. So I'm always happy.
You get more bang for your buck because when the stock price drops, the dividend
Exactly.
yield pops. Do you ever buy it? Do you ever look at the net asset value? Because I know if you go on SCHD's page at Schwab, it'll show the net asset value of the fund. And sometimes I used to try and time it to buy a few pennies below the net asset value to think I was getting a deal.
Yeah, no, I don't worry about that. I do look at the overall numbers, like make sure it's still tracking closely, that there's nothing off, there's nothing broken. And as long as that's fine, like I might check that, like if I'm on the page quite often, but every once in a while I'll look at that. But it's always right there. The only separation is like the expense ratio, if that. So no, I don't look at that. No.
Couple more from Big E. He wants to know, what's one piece of advice you wish you had known when you first started investing in dividends?
Well, I think it's something that people talk about all the time. Don't chase the yield. Like really look into the fundamentals. Make sure that the free cash flow can cover the dividend payout ratios. Look at the fundamentals and get under the hood, as you've been saying. Figure it out. And when in doubt, just buy an ETF. Don't be afraid. I mean, you could stick with ETFs 100% and probably do better than most people. So that is 100% fine. But I do think it is fun to get into some individual stocks once you've got some experience, and if you're not just buying off of what other people are saying. Like, do your research, find a method, make sure it's something whether it's like pick something you understand, you can follow, and then get into the fundamentals, look at those things, look at stock charts if that helps. Like, there's a lot of different ways to do it, but find a method that works for you, and stick to it.
Mine would be buying chasing yields, but right now I'm focused on the company paying the dividend, not the dividend and then trying to justify the company, which was the backward way I used to do it
Yeah.
with a few, and some of those worked out.
Like what started working for me in the beginning didn't stay either. Like things change. Like you learn more and more. Like I used to look at the combination between the yield and the dividend growth. And if it was over 10, I'd be like, that's beautiful. And I looked at a few other things to make sure, had a good ROC, like a good ROIC, and, a few things like that. And then after a while, that didn't always work either. Like it just doesn't always work. It's like I started chasing dividend growth, and that didn't always work because you know what? One year could be 10% one year, the next year is 3, it changes. So there's no guarantees in this stuff. So like you need to be invested in a good company at the end of the day, right?
And don't just get wrapped up in the titles like dividend aristocrat or
That
dividend king,
too,
because
exactly.
two kings cut their dividend. Was VF Corp, ticker VFC. They own Vans, Timberland, Dickies. They cut their dividend. They raised it for the 50th consecutive year. They got the crown, and then the next quarter they cut the
Think about,
dividend.
like, we got Walgreens, there was 3M, there's so many. It goes on and on. Like these guys are paying for years and years and years, and all of a sudden it's over.
Dividends are written in pencil. They're not in stone or permanent marker. Blue Collar Dividends from X says, I would love to know if there was one thing you could change about SCHD's methodology or fund construction, what would it be purely in a hypothetical world?
Nice. It's a great question. And I love the process. I still trust and believe in the methodology. People think, oh, it's broken because the returns haven't been great the last few years. I don't think that at all. It hasn't worked out, and AI has been the thing. There's not a lot of AI in SCHD, and that's the reason for what's going on. Has maybe a little too much energy I don't love, but that'll change as well. Like we're not going to stick with what we have today. The allocations will change, and things will work out over a long run. But one thing that might be nice is there are quite a few. If you go down the list into, when you get down to the bottom of the list, there's a lot of stocks in there that their dividend growth is pretty flat. You don't actually, it's 10 consecutive years of payments. It's not 10 consecutive years of growth. There is a 5-year average dividend growth rate, which helps a lot. But maybe consecutive dividend growth would be more ideal. Maybe it doesn't have to be 10, maybe 5, maybe something that looks at that, right? So you might avoid some of those choppy, up and down or flat. Like it'd be nice to kind of change some of those. But some of those help as well, right? You get a lot of these, some regional banks in there that have a nice yield, and you get them in there and you're just basically harvesting the yield from these companies, and they end up doing okay through the year too. So you get some capital appreciation out of them. So who knows? It might not help. What I say might not help.
Yeah, that would have been my thought. Just get some more dividend growth in there or something that's a little bit more consistent dividend growth. But hey, I know when we did the video last, because I was complaining that Ford went in there and I would never buy Ford. And then at that time, Ford was pretty much crushing the S&P 500 since it had gone into SCHD. So, you never know. Tommy Riley says he's be curious on recommended SCHD percentage allocation of a portfolio by age group.
Yeah, that's a great question. I get that all the time. I made a pretty thorough X post about it. It was based on a video by Jeff Teeples, which you've heard of Jeff.
Hey, I'll link to it. I'll put a
Oh,
link below. You got to
it's a
send me
great
that. Yeah,
video.
I'll link to your post.
Yeah, I have a post all about it where I broke it all down. But one cool way to look at it is kind of the way, like the old school way people would look at bonds, where you hold the percentage, your age in the percentage of bonds. We don't love bonds. They're boring. They don't grow like equities do. So you could think of SCHD as kind of an equity bond where you're getting the capital appreciation, at least the potential of it. And then you're getting that great dividend growth and a stronger yield most of the time. On average, over a long period of time, you'll have a higher yield than a bond would. So you could look at it and say it could be different for everybody, but you could look at that and say, okay, so when I'm 20, I could have 20% of SCHD or dividend type stocks, right? When I'm 30, 30%, and so on. And you might want to lower that. You can adjust that to however you want. I look at it as a big picture, as if I'm almost 50 now, believe it or not. I would look at something like 50% in dividend stocks and 50% in growth. Maybe you want to adjust that. Like you could go a little more growth, or if you want to be safer, go a little more dividends. But just kind of as a kind of a measuring stick to look at it, think of it in that way.
I like that. I like that. Thinking about SCHD as kind of a replacement for a bond,
Right.
something that would have, it would have, well, because bonds, obviously, that yield isn't going to grow. It's not going to appreciate in capital much. Or if anything, right, you have to buy at the discount,
But
but
you're not getting
it's,
any capital appreciation, and the yield is only going to go down. Like you're not going to get any unless you're doing all the laddering and all that sort of thing. But there's so much more. There's more risk, but there's a lot more reward with something like SCHD, and that yield is going to grow. I mean, it's been growing at 10, 11% over since inception. You look at the way that works out over 30 years, and it'll blow your mind. It's incredible.
SCHD is part of a healthy, balanced
That's
portfolio,
right.
right?
And I really do. Although my name is SCHD Stan, it is balanced. SCHD I use to counterbalance a lot of the tech and the growth that I have, because I've got a lot of Apple and Google and Microsoft and Amazon. I've got Palantir. I've got all this stuff. Plus, the S&P 500 index is by far my largest holding, because I just been every 2 weeks in that since I was 20 something, and I'm 50 now. So you can imagine that's the bulk of everything. So I would like something in times of corrections to kind of balance out. And I'm older now, so I do want to preserve some wealth, and SCHD does that for me.
You're older now. You're practically in a convalescent home. Look at you go. All right, two more here. Bill from Blossom, which I'm on Blossom. You're not on that much. You got an account
I
there,
do have
but
an account. I keep promising to go more. I'm going.
yeah,
I do.
it's what I'm like. I migrated off X, so I guess I live here now at Blossom. But Bill anyway says, should someone who has SCHD in their portfolio be concerned that 54% of SCHD is focused into only 3 sectors since the last reallocation? And how should those worried about the lack of diversity adjust their outlook on SCHD and adapt their strategy? So people that are worried about the diversity of SCHD, and I think at reallocation he meant to say reconstitution. So I fixed it for you, Bill.
The cool thing about SCHD is it does look at things and rebalance, reallocate, at once a year. So it won't be the same for long. Like, and to me, it's a long holding. It's not something you buy for a year or two. It's a decades investment. So again, going back to like people just being disappointed in it, if you're looking at 1 year returns with SCHD, you're doing it wrong. It's not for you if that's what you're looking at. Long-term holders of SCHD can rest easy that those allocations, if we're heavy in a certain sector now, or like you said, combining three together, over time that will adjust. And I agree with you. I don't love it. I think there's too much energy in there right now. The year's not done. That may still work out. We don't know. Like people are so quick to say, "Oh, energy's killing it." It is, yes, but we don't know how this is going to turn out. We don't know what happens tomorrow, the next day, the next. We might be thanking our lucky stars that energy's in there if something changes. So I just trust the process. And but maybe that's another thing. When you asked about what we'd like to change, maybe put a limit. Like right now, there's a sector limit of 25%. Maybe it should be lower. Maybe it should be 20%. But you know what? If it had 25% tech right now, everybody would be happy about it, and you wouldn't hear a peep. You got to take the good with the bad, or the bad with the good in this case.
So it's again knowing what you own, and you trust the process, and that it's. I don't know what more you can say. This is what it does. Once you know how it functions, you either trust the process and own it, or you don't. And
Right.
what are these years and decades you speak of, Craig? I mean, we need returns now. 1 week, that's what we got. We're giving a week.
Like Ari says, Rich by Tuesday.
All right, last one from Jay Ray, also on Blossom, says, any comments on the Vanguard and Goldman prediction for the poor market return over the next decade? Value and international will seem to overtake growth. I know you can't time the market, but there has been times of decreased returns in the market's history. What do you think about balancing international? I'll just jump in and say I actually started buying SCHY. The way I like to explain it is the international version of SCHD. It's all international stocks. And same thing, you trust that process and it's got its selection methodology.
Yeah, and I think he also pointed out value as well, right? He was saying a shift to international and value.
Value and international will seem to overtake growth.
Right. And to me, that's a good, and we don't know what's going to happen, but this is why I like to have a more balanced portfolio, because SCHD is a value, leans towards value. So it will help if things change. If they don't, well, we own the growth side too. So you get the best of both, but you're going to get hurt in some times and helped in others. So, but the balance does help you through those tough times. And if you are looking to retire in the next 10, 15 years, it's nice to have that balance. So like no one cycle can like completely destroy you and make you have to work for another 10 years and wait it out. So if that does happen, which we don't know, it's good. It's good to have some SCHD and other value type stocks and dividend stocks as well.
Maybe it's like the goalie on a team. You don't expect your goalie to skate up the ice and score 50 goals in a season. No, his job is to stop the puck. That's what his job is for. SCHD's job is not to beat the market. It's to pay steady and reliable growing dividend income from an ETF that holds great dividend paying companies. And if the market should downturn, probably won't go down as much as the S&P 500. Like that's its job. And I don't know why people are expecting it to be a high flying ETF.
Right. A friend of mine on X, Jay Dilks, made a great analogy. He said SCHD is like a great defense in football that will get you some turnovers, will get you the occasional interception, fumble recovery, and every once in a while we'll return it for a touchdown. It's not just strong defense, but it's going to play off it, like get you some points every once in a while as well. So I thought it was a fantastic analogy.
I like that. Yeah. Like sometimes it'll do really well, but most of the time you don't expect it to.
Yeah.
Now you'd be crazy to expect 7 pick sixes every game. This is not going to happen.
Right,
That's not their job.
It's like your sixth man off the bench, a real solid player, man. He's not your star. He's not the star, but he's solid. He's there at practice every day. He's a good leader. He's a good character guy.
All right. So, dude, anything last you want to say about SCHD? Any crazy words of wisdom or anything that we should be hanging on your every word for?
Find your way to invest and like stick with it. Don't chase the newest thing out there. In the long run, things work out. Like I just think SCHD is going to be just fine in the long run, and if you're in it, stick with it, or hey, do what you want.
All right, so they can reach you at SCHD ETF, right?
That's
There
right.
you go, right down there.
Stand. You got
You can talk with him in depth. Tell him all your problems, troubles, worries. He'll put you on the couch and work it through with you. So maybe he won't. I don't know.
it. Thank
It's his
you.
life. He can do whatever he wants, right?
Thanks, Russ.
All right. So, dude, thanks again. This was fun. And 2 years from now, we'll do it again, right?
Sounds good. Thank you so much.
All right, everybody else. We'll see you guys later. Take it easy.